All right. So we have Josh Perez here from Synergy Mortgage Group, and Josh is a mortgage broker that our team works with and has helped some of our clients and us out personally. So want to have Josh on here today, ask a couple of the burning questions that we've been receiving quite a bit, and put this out there for you guys to kind of answer some of the questions regarding the market. Obviously, some changing market scenarios and interest rates and things like that. So figure we get an expert in here. So thanks for being here, Josh.
Yeah, no, thanks for having us, guys. It's a pleasure, and looking forward to chatting about real estate mortgages and what we got going on in this exciting world right now.
Awesome. Well, we'll kind of dive right into it. And I guess the first kind of question is like, what are you seeing out there? What are your clients feeling? What are the conversations you're having? And, is there uncertainty out there? What's kind of your feelings on the market right now?
Yeah, so great question. Kind of a temperature check of what we're seeing right now. I mean, I think to build better context of what we're seeing right now, it's a good idea to maybe compare like what we were seeing maybe 6 months ago, 3 months ago, a year ago. So generally speaking, clients that we work with typically are pretty close and even split between people looking to buy a home for themselves to live in, whether it's the first time they're buying a home or they're selling and buying their next home, and investors. So looking at typically cash flowing rental properties. And so 3 to 6 months ago, very, very heavy demand, competition in almost like every market. Generally speaking, most of our clients are in Southern Ontario. We do have clients out of province from time to time, and generally the temperature around that almost everywhere with investment properties for sure has been a lot of competition, a lot of demand, not a lot of supply, right? So obviously, and I'm sure in your markets that you guys are primarily focusing on, you're seeing multiple offers, competition, buyers needing to go in firm, no conditions.
Yep.
So that was the norm for quite a long time that I see kind of on the mortgage side when we're pre-approving clients. Fast forward to right now after a few rate increases, with the Bank of Canada, which impacts just variable rates, but also fixed rates growing quite a bit. Definitely we're still seeing competition in certain markets, certain situations. It seems as though, generally speaking, and this is new, I would say in the last like maybe month, we're starting to hear that there's less offers, let's say, on most properties. Like there are still ones like that have 8 and 10 offers, and are still ones going over asking. Like there was a fourplex in Hamilton that we had a client purchase that was 250,000 over asking. So those situations are still happening, but it seems as though we are hearing more and more of situations where clients are able to secure an accepted offer with a conditional period. Not having to outbid 10 people or 5 people, maybe it's like 1 or 2, and also seeing situations where clients are approaching a property that's been on the market for maybe a week, 2 weeks, a month. Generally speaking, on our end, we just didn't really see that happen a whole lot, prior to maybe like 6 weeks ago. So in that sense, it's looking like certain clients are able to have. It's tough to say what a property would go for relative to the list price, but it seems like there's still a lot of buyers out there. But I think maybe some people have gotten maybe a bit spooked with a lot of the actual rate increases, and then also the projected additional rate increases that are happening, which feed into ultimately, the cost of borrowing. When those people who are buying a house or buying an investment property, they're not buying, a $500 or $1 million house in cash, right? So they have part of their own funds for down payment, and then they need to borrow money, right? So that cost to borrow the money for that mortgage has gotten more expensive. So as a result, it seems like that's slowed a bit of activity on the pricing side. As a mortgage broker, while I'm in tune with my own kind of investment properties and clients and what they're buying, I don't see the data every single day. I am looking at kind of reports, but that's something, I'm not sure, like in your guys' markets, are you seeing prices, soften or majorly adjust just yet? Or is it more about like the offer process that you're seeing some actions?
I would say, and then I'll let Nick kind of chime in here as well too. But I think that we're starting to see that as well. And I think I would completely agree with your statements there. I think people are spooked. That's a pretty good word for it. They're just kind of uncertain. I think you're seeing things where You have massive inflation, interest rates going up, pricing's at an all-time high. You have a war going on. There's just so much going on right now that's kind of with a lot of uncertainty. So I think you're seeing that. When it goes back to pricing, we've seen it too, where we've seen some pullback on pricing. We've seen some things slow down. And again, going back to that, where maybe a property before would have 10 offers on it, we're seeing 2 or 3, and you're not getting that massive over asking price. And in some cases, I think the sellers are still tied up with what the neighbor got down the street, a couple weeks prior or a month ago, and they're still kind of holding on to that, where we've seen a little bit of pricing kind of come down a little bit. So we're starting to see where people, hold offers, not get the price they want, either relist at, that market value or what they want. And then they sit on the market for a couple of weeks. But I know for a couple of properties that we've sold in London, like, for where Nick is, a couple of situations that I'll let you speak on, Nick, in terms of pricing.
Yeah, no, basically what Colin touched on there. We had one earlier in the year in Westmount, London, had about 75 showings on it, 17 offers, sold for a little over 400 over asking. Obviously that was underpriced. We knew that we were going to get a lot of activity with that strategy, brought in a ton of activity. About a month later, similar area, similar size house, similar square footage, similar strategy. We ended up with about 17 showings and 2 offers total. We're still able to kind of pull a solid sale price from it, but just in that kind of like month period, exact same area, very sought after, just a complete switch. So I think for us to going in beforehand and like setting those expectations with our sellers, letting them know that things are kind of changing, letting them know that interest rates are going up, kind of taming their expectations before they get into the sale price has been something that we've definitely needed to start doing in the last couple of weeks here. And then to touch on kind of where you were, and sorry to go, but kind of what were your expectations for where you see rates going in the next month, 2 months, half year to year?
Yeah, so no, that kind of plays into it. So, I mean, we've seen and generally speaking, kind of where we were and where we are now and where we're going. I mean, it wasn't too long ago, I want to say maybe 8 months ago, where, fixed and variable rates were both like variable rates were in kind of like the low ones, mid ones, and fixed were in that low 2s, high 1s for a short period of time. And now, we're right now fixed rates across all lenders, banks, credit unions, mortgage companies are just creeping into the low 4s, like 4.25. If you're getting an insured mortgage, when you're putting less than 20% down, you have the CMHC insurance, those are always the best rates. Those right now are you can get a couple lenders right now just under 4, but they're starting to creep up. So we're seeing, 4.25. If you're buying a rental property, it's usually priced at a premium. Again, talking about fixed rates, might be at 4.5%. The variable rates right now, depending on the discount and the lender, you're in, the mid 2 to 3 range. So there's still like a pretty big gap there between the variable and the fixed rates. They don't move hand in hand. So the fixed rates have actually increased way before the variable rates have now just increased, right?
Yep.
But the fixed rates are still kind of incrementally bumping up. So right now, that's kind of where we're at in terms of the rates today. So, again, going back to the example of, 5 to 8 months ago, I try to kind of work numbers in, okay, the cost of a mortgage, like per $100,000 of mortgage, right? So generally speaking, on a fixed, prior to where we are now, the cost is about $400 a month per 100,000 of mortgage, generally speaking. Now we're sitting at, with current fixed rates, around $500 a month per 100,000. So, you have a $500,000 mortgage. The cost and budgeting, if you're out shopping and didn't find anything 6 months ago for that same price house and payment and same down payment, if you're looking for a $500,000 house, an extra $500 a month in payment if you're taking a fixed. Variable rates are right now, the rates are still about like $400 a month per 100,000. You're getting a discount to where the fixed is. Variable rates might go up. It's sounding like they will. So generally on our end, I mentioned that, fixed rates are in that, 4.25 range. Where do we see them going? I mean, there's all kind of different analysts saying things. What I'm doing, It does sound like there's probably some room where it's going to bump up again, mainly to combat inflation. That's still not really anywhere close to in check. And that's kind of like last tool that, monetary policy, Bank of Canada, kind of reserve banks are doing to try to help that. So, I think, it wouldn't be crazy by the end of the year if we saw those bump up close to 5 variable rates. So their price of the Bank of Canada rate and their prime rate, we're hearing, should probably build in another maybe couple rate increases. So traditionally we've seen quarter point increases. Last increase we saw 0.5 point. So collectively, I think it's possible we see another like full, like 0.5 to full percent by the end of the year. Some people are predicting more. So that variable rate that's mid to high 2s right now might jump into the mid 3s to high 3s possibly. So still though, when you look at that, where we think we're going, we're still that gap between the variable and fixed, right?
I think that was something that we were going to ask too, is kind of what some pros and cons were between the variable and fixed as we see rates continue to rise.
Yeah. So the one thing is like, there's a period of time where the gap between fixed and variable, to take a variable rate, which you don't know if it's going to go up or down, and right now it sounds like it's going to go up, was pretty close to where the fixed is right now. Like there's a pretty good gap still, like almost 1.5% today, and possibly like, and even actually a little bit more with some lenders. So if we see where that gap is, like the one thing is that there's two things really. It's, we map out, okay, you're getting a mortgage today, your payment can be $2,000 a month with a variable, or if you go ahead and take a fix today, you're knowingly taking a higher interest rate and a higher payment. Maybe it's $3,000 a month, maybe it's $2,800 a month, whatever the example is, but you're knowingly taking that higher payment. So what you need to know is, if you decide not to and you take that variable, like we want to build in a scenario of, if rates go up, right, and what your payment might jump into. There's a couple lenders that do what's called like a static payment, where your payment doesn't change. There's not many of them, but generally speaking, like we want to kind of build in a budget to plan for those increases, right? And so what we do when we're pre-approving a client, or even if it's like a live situation when they have a purchase or refinances, always try to just like provide a budgeting scenario of like what things could look like reasonably, so that you're prepared for it. That's not your payment today, but our recommendation to go a bit deeper is like, you should build into your budget, being prepared to pay X, if that makes sense, if you decide to go with the variable. The other main reason with variable versus fixed is that just penalties, we see it as like mortgage brokers, like every day, like real life things happening. And the stats are like, about 70%, almost 70% of Canadians break their mortgage at the 3-year mark. Yet the most kind of common mortgage product is the 5-year fixed, right? So it's kind of like breaking a cell phone, except like the dollars are way higher, right? So I know when you talk to most people about, breaking their cell phone contract or signing a contract, you're like, no, I want some freedom, I want some flexibility, I want signing on with Rogers or Bell for too long. But for whatever reason with mortgages, there's not that like, question asking, interrogating as to why am I signing on? What happens if this happens or that happens? And as a result, if someone wants to move or sell their house, often with most lenders, you can, if you stay with them, they have some solutions to waive the penalty or give you a discount to what the penalty is, but it really restricts your flexibility for things that might pop up. You might need to move, you might want to upgrade houses, you might want to access that equity to put towards some kind of financial priority or goal. Maybe you want to access equity to buy a rental property. You might be restricted, and the penalties with fixed rates are generally like 4 to 5 times higher that of a variable rate, right? So in a lot of cases, we're looking at average mortgages somewhere between 4 to 800,000. Let's just say, breaking your mortgage with a fixed rate at that 3-year mark, like we could be looking at, we see penalties regularly of like $15,000 to $30,000 to break it on a fixed rate. Whereas on a variable rate, might be like $3,000 to $6,000 for that same mortgage. So you don't want to pay any fees in those situations. However, for most people, like their home or investment property is like one of their largest assets. It's also a source of like their largest like piece with that equity of their net worth. And so, when you're wanting to have access to that or use that, you're really like handcuffing your ability to do something with it or move on to another life priority. If it involves just, moving your family, getting into a different city or location or school zone, or just having enough space as your family grows. So that's the big one with the variable, that we really make sure that we have conversations with clients about that versus just being like, hey, I heard, what's your best fixed rate? Cool, that sounds okay. Conversation over. It's like, okay, well, maybe we should talk to you a bit about the variable. Yeah, in nature of variable payment, that could change, sounds a bit scary, but in seeing kind of history of fixed and variable rates, like generally speaking, over almost every 5-year period over the last 30 years, the variable rate has actually outperformed the fixed rate. But a lot of people don't know that. But it is a time where variable rates are clearly have increased quite a bit and will be increasing. It's just always coming back to the goal and your purpose of a property where we make a recommendation. That's typically where it comes down to. So I still think there's still very good value with the variable rate now relative to the fixed, but you really got to understand and also know yourself, right? We might have a conversation and say, hey, Colin, so be prepared. Your rate might go up, your payment might go up. Then you're talking to friends, you're in a variable, you're seeing news articles, social media, rates are rising, and then you're just not, you're getting anxiety, you don't feel comfortable. That's not healthy either, too. So always make sure to say, hey, you got to know yourself. And even though you understand this, like, yourself emotionally, are you going to be able to handle this if your payment actually goes up, right? That's really, really important to us.
We're seeing or we're starting to hear anyways, some tougher qualifications potentially coming down for investors, doing minimum 35% down payments versus the 20, increasing capital gains from 50 to 75%, no borrowed money for down payment regarding no home equity lines of credit or line of credit for borrowing that down payment. Are you starting to hear these things? Do you think that this is something that's coming? What are your thoughts around this?
Yeah, so literally in the last week, went from hearing one or two rumblings to starting to see some mainstream news outlets kind of peddle this a little bit. And it's definitely sounding that, like, not just speculation, but also some commentary from the regulating body of mortgages and lending, that and they don't speak much on these topics, and they released a few kind of statements around this topic. And so based on the language and the sources of where this language is coming from, it definitely does sound like next year, and they're kind of saying right now, like Q2 of 2023, that there's going to be some kind of changes with regard to, the down payment minimums on investment properties. Sounds like it. There've been times where there's scare tactics to cool the market, and if things cool off a lot between now and end of the year or Q1 next year, maybe that changes their need to have to do that. But right now, it definitely does sound like next year, like for myself as an investor, I'm starting to try to think differently and pull on different resources to try to understand and digest what that might mean for existing rental properties, smaller multi-units, larger multi-units. CMHC launched a very aggressive program in the commercial lending space just recently. That might have an impact too on cap rates and what properties are trading at and what people can afford to pay for properties based on more favorable lending criteria. So it's very new that kind of release has come out, but as an investor, I might plan that next year, if I'm still shopping, that I might have to have a bit more capital available if I want to pursue the asset class of rental property. The other thing with that, though, is there hasn't been language on how this might impact alternative lenders or private lenders, right? So you have your banks, credit unions, mortgage companies, like best rates, right, that are available. Then you have like alternative lenders that have slightly higher rates, but they also do have like a lot of regulatory criteria that's involved in getting a mortgage, but sometimes the rules don't apply to all lenders, right? So we don't know if, okay, investors can still buy these properties with 20-25% down, but the cost to do so might be a little bit more. We're not sure if that's going to impact the alternative space as well. So that's another piece that they can kind of fill in. It just might become more expensive, capital intensive, or if it's going to be both.
All right. What are you kind of predicting here moving forward towards the end of 2022? What were your thoughts as we kind of wrap this up? What are your thoughts with the market? Do you think that we're going to kind of, maybe trend towards a more balanced market? I think we're still favoring sellers, just not as drastic as it was at the start of the year. But, what's kind of your opinion on where the market's headed as we kind of, round out the end of this year?
Yeah, listen, it's very similar, I think, right now to, spring, like pretty much exactly 2 years ago. I'm looking at end of April, maybe even like 2 weeks ago. I remember when, the first kind of lockdown came around, and the first thing I started thinking about is, I need to get in touch with everyone in my industry, at a high level, and see what they're thinking and talking about and what they're hearing, right?
Yeah.
And and then look what happened to the market, right? Real estate like blew up. Lending, there were a couple parameters around like lending criteria tightening up a little bit on some things, but generally speaking, no material changes for an extended period of time. But right now, I'm trying to do a lot of the same, talking with realtor partners like yourself, appraisers, banks, lenders, other people in the industry. But right now, what I'm seeing is, if rates continue to increase, right, and more clients are a bit spooked, or budgeting just is not allowing them to pursue property that they once wanted to do, perhaps there's going to be a softening of prices. Maybe. To what extent, I'm not sure, because there's a lot of demand for housing, right? So I'm not sure to what extent. But you know what? You could look at the theory of like, my cost of borrowing is more expensive, but maybe the price of the house now is lower, so it's possible maybe they offset, right? Maybe I don't need to shop for a house for 1.2 million anymore, because the criteria I have can be satisfied now at price points at 1.1 or 1.2. Maybe that swing in price point reduces your required mortgage amount, and at the end of the day, your bottom line is maybe the same. Not sure. What I'm trying to do right now is just making sure that people that we're working with are in tune with their budget, really in tune with what their criteria is for a house and investment property. Go back to what's the goal here, right? Refreshing. We're doing a lot of refreshing conversations with people who are kind of in the market looking for things, and going through numbers and making sure that this is your criteria. But the other thing too is like, I did this a few months back, and I'm seeing more and more investors, is the need to control the equity in property that you have. So how do you control equity in your property? Like, unless you're selling a property, you don't really have access to it unless you set up a home equity line of credit or refinance a mortgage. And why it's important to access that equity is if you potentially want to put it to use. I think right now, more than ever, the need to outpace inflation with your assets or investments is like getting more and more challenging. And so, now more than ever, someone, when they say, oh, inflation, like, how does it relate to me? Like, literally, you're seeing it in every kind of place that you consume or spend money. Like, everything is more expensive. Everything is slower. It's clear as day to everyone. No one can be like sheltered from that, right? And so now I think people are buying into the thought of like, what are you doing for savings or investing, right? And a lot of people over the last few years have benefited from the rise in real estate prices, right? But let's maybe have a conversation on how you can put that equity to use, potentially buying an investment property, maybe topping up your investments. The goal is, you're borrowing more money, right? At 3 or 4% or 4.5 or 5%. The goal is like not necessarily the cost of the borrowing, but what are you going to do with that? Can you generate a rate of return of 20, 25, 40%, which typically, like a rental property, when you add in cash flow, principal pay down on a mortgage, and long-term appreciation, even if a couple of those things suffer, generally speaking, like you're generally going to be over a long period of time somewhere in that 20 to 40% range when you look at the money that you invest in purchasing a property, because you're not buying a house cash, you're buying it with maybe 20% down, maybe a little bit less. And so the controlled access to your equity, making sure it's approved, it's accessible, those conversations I think are more and more important, and really taking a serious look at where your capital is invested right now.
Well, awesome, Josh. No, I appreciate it. And that you came on here and chatted with us for a few minutes. Once again, Josh Perez with Synergy Mortgage Group. So we'll link your contact information, Josh. You've helped a lot of our clients and done a fantastic job. So if anybody wants to reach out, we'll have the contact information below this video. But thanks again, Josh. We'll have to catch up here in a couple of months and see if some of these predictions and what we've talked about here is accurate. But who knows? This market's interesting. So thanks again, Josh.
Great. Yeah.
No,
Thanks a lot.
Thanks a lot, guys. Really a pleasure. And yeah, you know what? It's an interesting time, but you got to keep the dialogue going, whether it's, you know, good or bad. I got to spend
100%.
time with people and getting to know, you know, what's important to them, and just relaying information and being the best resource you can. So, you know what? Happy to chat, and thanks a lot, guys.
All right.
Cheers, buddy.
Thanks a lot. Have a great rest of your day.